Yeah, Joe, take it from the top. Introduce yourself and SI partners.
Cool. Are we good to go now?
We are good to go.
Brilliant. Okay. So yeah, look, my name's Joe Hine. I'm one of the partners at SI Partners. SI Partners is a global boutique investment bank. We operate across the globe through New York, London, Singapore, and Hong Kong. And I spent 10 years helping entrepreneurs work out where they want to go and what they do when they get there. What does that mean? It's I build value in businesses or help them build value in businesses, and then I help them realize it. So I spent about a quarter of my time working with entrepreneurs to create value and find strategy. And the rest of my time was within what most people would call M&A, selling businesses, whether it's to strategic, to private equity, buying businesses for client, or everything that sits in between. So,
Okay.
Yeah.
That's interesting. And has that always been your background?
No, yes. I've spent 20 years in and around M&A, basically. I mean, I trained as an accountant at PwC and I spent 7 years there. Majority of my time was in M&A environments. And then I was in industry and I worked for some startups for a while. I worked in digital online gaming. I worked in mobile, sort of various different roles, but always sitting alongside marketing teams, alongside the finance teams, looking at new product development, looking at M&A before joining SI Partners.
Okay, so that gives you like a good solid grounding in understanding both agencies and software companies, right?
Correct. Yep, I've sort of seen it from many different angles.
Brilliant. Okay, Joe. I've explained to you what we're doing here today, but obviously for our audience,
yeah,
what do you do in particular that can help them? Right, the whole purpose of this thing is about growth, merging, and exit. So why don't you kind of dive into that a little bit for us and unpack it?
Yeah. Okay. So, I mean, look, kind of, you should come and talk to me if you've ever thought about realizing value in the shares that you have in your business. In short, the point at which I talk to people is normally twofold. One, when they're in a position where the business is gained traction, they're in a good place, and their mind's starting to think about what next and is there opportunity out there. And it's that kind of really, it could be relatively early conversation of, I just like to understand more about how the market works, more about what should I be doing 12 months out, 24 months out from thinking about, I might want to realize some value. Or there's an event that creates a catalyst. We often work with people that are looking to put in share options in a business and understand that properly. Look at people who are looking to, they might have shareholder difficulties, buying shareholders out or changing the shareholder base, and we can help with that. But most often it's when someone might have approached them and said, kind of, we're thinking about, we'd like to buy you or we'd like to invest into you. And at that point, it can be helpful to have someone alongside that's done it before. So yeah, a lot of cups of tea are starting that way.
Okay, and I suppose that's like come to me if you need help. But how is like the micro and macroeconomic situation affecting M&A in the space at the moment?
Yeah, the macro world is pretty interesting at the moment. My read on it is that we have been through a period of relative global stability and free money for about 20 years. And I say free money in the sense that we've had 0% interest rates. And that's created, all of our whole economy has got used to that, right? So house prices is probably one of the things that people touch the most. But all the financial institutions are used to this. And it's driven this wave of investment into the business at a time of technological change and the digital revolution. So much of all the tech companies are VCs that have plowed money in, and kind of, if you look back over the last 3 or 4 years, everything was free. You got subsidized Ubers, you got a transport, you had subsidized deliveries of whatever to your door, and the change in investment rates and COVID has basically, part as a result of COVID, has completely changed the system. And so we've got a massive period of adjustment at the moment. And that adjustment is the financial systems going through and working out how do they remain stable within it. And so that's why you're seeing these banks get bought. It's very controlled at the moment. Is it the end of it? I don't think so. Is it a disaster? I kind of hope not. But one of the more sort of profound things is what it's doing to the landscape of VC-backed businesses, or a lot of them are pre-profit-backed businesses. And I think it's having the most profound effect on them versus some other businesses that generally are trading quite well.
So I remember, of course, it might have been last summer, was a SaaS stock London meetup. And there was another VC person sitting there, and we were talking about, like, the taps being turned off.
Yeah.
But what's your sense of poor fiscal management? And you probably want to stay like agnostic to this answer, but I feel like there was a bit of this sense of competition. Like, oh, if you're going to offer free lunches, we need to offer free lunches. If you're going to offer free travel, we need to offer free travel. But is that really sustainable when you're fiscally responsible in managing and running a business?
Yeah, I mean, I think that's the whole point about the change in the interest rates and how it's really biting everyone. And it's biting people in their pocket, and it's biting all the institutions, right? Because they've based their entire business models are based upon 0% interest rates. And if we look, you're talking about funding and the consequences of funding. The money was so cheap that why wouldn't you spend it irresponsibly if it was easy to raise at valuations that were ridiculous? So you've got literally, it's the coupling of free money and the digital revolution that's kind of got us to where we are today. COVID accelerated that massively. As everybody knows, is anyone who's involved in digital, that was the only world that you could exist in. So therefore, that's where the investment went. And then suddenly we see the interest rates change, and everybody sort of stopped looking up, and thinking, right, okay, what's going to happen?
And that's a really good segue into my next question, because I'm ex-CSFB, right? So to see them in the news and watch them going the way they are, it's probably not the nicest feeling. But if we roll back to SVB and we look at their business model and backing of loans with pre-IPO valuation, like a lot of people on this call might be thinking, well, if I'm going to get into like a sale or a merger, and we're doing this on today's EBITDA valuation, like, how worried should I be about that type of investment, and how could that affect me, and what should I be planning for?
Yeah, okay. So I think there's now a huge divide in the industry, right? In people looking at equity events, let's call them, raising money, selling their business, whatever it is, but trying to value their shares. If you are pre-profit, I think you've got trouble ahead, and the market doesn't know how to respond at the moment because no one's got an idea what's going to happen. I'm in the middle of negotiations with a pre-profit, very large VC-backed, very scaled business, but it's pre-profit, trying to buy one of my clients that's post-profit, right? That's profitable. And it's a very difficult conversation because no one can make a judgment as to what their shares are worth. And obviously they're trying to trade off their shares. So everybody that is in that pre-profit position is protecting cash at all costs at the moment. Because you do not want to have to go to market to raise money either in the debt markets or in the equity markets in the next, I would say, 12 to 18 months. So I think you're going to see a real slowdown from the people in those sort of those spaces that don't have the balance sheet, currently have the balance sheet to support them, or easy access to very supportive investors, which I think they're going to have to be asking some questions of themselves as well at the moment for their LPs and so forth. But on the flip side, I think anybody that's post-profit, the market is still pretty buoyant. Like there's a lot of, I'm finding that that there is more buy-side demand than there is supply at the moment. Okay. I think a lot of companies are looking at their their future trading, and they just see some uncertainty on the horizon, and that creates a bit of concern. And it's not the time that you want to do something unless you have to. But for people that have got good visibility or are trading well, there is a lot of demand in the marketplace for buyers to buy businesses.
And so does that mean we're potentially going to see the rise of the bootstrap unicorn, or is that a bit of a fairy tale?
I think so. Yeah, I think you're going to see a lot more financial prudence. Absolutely. hopefully people can get to unicorns there. But I mean, if you think about what a unicorn is, it's dictated by its valuation, which is dictated by the multiples that people investing free money was prepared to pay. So I think the idea of unicorns is something that's going to become rarer. But I do feel that bootstrapping is going to become much more common, certainly in the short term. I mean, the only counter to that at the moment is there's still huge amounts of money in the system that needs to be placed. There's so much wealth that's been created over the last 20 years that is sitting out there trying to be put somewhere. I just think people are going to be more prudent about where they put it and when they put it.
Interesting. And sorry, this one's come a bit left of field whilst I was sitting there listening to you talk. In terms of the ChatGPT revolution, are you seeing impact in the business you're doing from there? You're looking at HubSpot are integrating it. There's some big tools being built on the back of ChatGPT now. And is that influencing M&A in any way?
Well, if I go and talk to all of the people I know, all the buyers and the investors that I know, all of them will put on their list now, AI, ChatGPT as one of the things that people want to invest in because it's hot, because it's new. There's a huge scurry to understand how effective is it going to be. And I think there's a lot of opportunity, particularly for lower level production-based tasks to be made much more efficient. I think the limitations of it at the moment, i.e. it can't work off of contemporary data, or it doesn't work off very contemporary data, mean that we're not going to see AI being as mainstream in M&A, kind of in the short term. And if I explain a bit what I mean by that, clearly there are people that are using AI and, the very tech heavy people in AI, those deals are happening. Those deals are still happening. I mean, they're slowing down in the marketplace and, off of kind of some of the highs that they've had. It's what we now need to do is see people embed AI into their businesses. And then that's then when they're going to come to the fore and command very high multiples. But people are working out what it is and working out how to embed it. So I actually think, like the hype cycle always says, I think we're probably 12 to 24 months away from seeing, loads of businesses use it effectively and then be able to sort of monetize it and then, in a position they can sell and realize value from it.
Interesting. And so to come back to more of the topic at hand, I suppose, especially for the agency owners, I think a lot of people are considering selling or merging.
Yeah.
And if we just start with merging, considering our pre-conversation, what would you advise people that were considering merging with another agency?
Look, mergers are really difficult to make work. Not impossible, but difficult. And the main reason is that you're taking your shares, you have 100% control in your shares, in your business, and you do with it as you please. And you're going to couple up with another business, which, the best will in the world, no two businesses are exactly the same. So therefore, you might have 50-50 of that business. You might have a differential shareholding in that business, but you're suddenly having to share control, and you have a percentage of the business rather than full control of it. And that's quite a big leap for a lot of people to take without having money changing hands. And if money changing hands, it's really an acquisition. Now it does work. I've seen it work where you get people that really know each other very well, have worked together before, trust each other, maybe even have businesses together before, and they go, look, kind of what you've built, what I've built, let's work out a way to bring it together. And that's when you see it can be successful, but often it's too much of a leap of faith. And the reality is that majority of mergers just becomes a more of a philosophy for buying businesses and your approach to how you want to bring people alongside, which actually in that context can be very useful.
And is there a lot of this? Is this versioning from what you're seeing on your side?
No, not a lot, and I don't really expect it to. What I am seeing is, and have seen as a real trend in the last, I don't know, 3 or 4 years, maybe a bit before, is ambitious entrepreneurs. Whereas a lot of people would build a business to a certain size and sell. It's quite common, particularly in the UK market.
Yeah.
We're seeing a lot more ambition within the UK market to buy and build, to actually go out and acquire businesses that some of them are relatively small, and then sort of slowly as they scale, getting bigger and bigger. But certainly that, maintaining the, your own, managing your own destiny and not selling out, but taking money on in some capacity and growing, or being, smart about the resources you have to grow. Seeing a lot of that, and I expect that to continue.
Okay, cool. That's interesting. And what about growth opportunities in the market? Where are you? You're UK, Europe, is it EMEA, North America? Where, Asia?
Yeah. So we're completely global. We are, our focus is on entrepreneurs and on, the digital economy. So we remain quite niche, but we're absolutely global in our outlook, and in terms of our, kind of our business.
Mm-hmm.
Where are there growth opportunities? Look, I still think that anybody that is looking at tech enablement, tech enhanced services, where they are driving efficiency through their clients, or driving efficiency for their clients, there remains a huge amount of opportunity. That's where we're seeing demand, is the use of technology to enhance people's businesses and the tools around that. Anybody that's building tools that either, are within their business, create great efficiency, or, potentially a wider use, creating great efficiency. There's a great amount of opportunity. Big caveat on that is don't try and do both. Either you're a SaaS business or you're a service business. You can't be both.
So that's interesting, because a lot of agencies are trying to build tools now. I feel at least one agency in a mastermind group I'm with, they're definitely building tools around the analytics for, and sort of like those things, and trying to use them as lead generation tools. What's your take on that?
Yeah, look, I think that is absolutely the way that businesses should be going. Building tools that enhance what you're doing. If you look at the cloud computing businesses, exceptionally hot at the moment, the really successful ones build tools that just make, the processes easier, that they then can either use internally or potentially even externally. And there's, in tech, it's very easy to do that. I think you've just got to be really careful about how you allocate resources. The really dangerous part for me is when you say, I've got something here, I think I can sell it to other agencies or other businesses, not to my clients. That's when you're changing your business model. And I think you've just got to be really careful about going down that path, because you can become very schizophrenic, and that can be quite destructive.
Interesting. So we've touched on mergers, we've touched on growth. So what about acquisition? I suppose there's a couple of questions that spring to mind for me. The first thing is, obviously, before we spoke, I'd mentioned that there was at least one agency in the US that was kind of focused on being a facilitator for agency to agency sales. And I've spoken to other agency owners that have looked at this particular business. I won't name it, but they have called into question some of the valuations. And some of the valuations that have been questioned on EBITDA are based on permanent headcount and things like that can influence actually what the true value of a business is. So for people that are thinking about valuing their business, from your perspective, how do you really value an agency?
Well, I mean, that's an interesting question, because like anything, the value of your business is only what someone will be prepared to pay you for it. Valuations vary greatly depending on what you're trying to achieve. An obvious example would be putting in share options, and there's all kinds of approaches that you might take to lower your valuation for some logical reasons as to why you might do that, to make it really efficient. But if you are able to sell it to a third party, and third party is prepared to pay for it, then that's a completely different ballpark. I find it really interesting that you would offer up a valuation on a business as part of a sale process if you're going out to market. because you're never really testing to where the market might, or where a valuation might come from, what the market might bear. The rare time I would give guidance is if somebody has approached a client of mine, and then you've got a lot more license, because you know that you're in different situations and powers in your court. If you're going out to the market, you're inherently on the back foot until you've got interest and competition in there, because you're going to somebody else to say, are you interested? So the idea of offering up a valuation day one, for me, I don't know. I think it's, I would approach that with a healthy dose of caution. And there's, it's a very complex business, selling your business, the kind of, from the preparation through to understanding the market, access to the market, really knowing how to do, how to sell your business, through to technical execution. There's a lot of different skill sets that are required, different levels of support that are needed. And there's some emerging models in the market, and I would just be, you kind of get what you pay for, is what I'd say.
Okay. And just off the top of your head, without giving away the secret sauce, are there things that you might advise someone like myself? You might say, look, Paul, if you really want to get into the best shape, your business might want to look like, for example, 50% retainer over 2 years, or blah blah blah. Are there things that people are looking for, certain markers, when they're buying service-based businesses?
Yeah, I mean, look, absolutely. There's different markers. I mean, it's a balanced scorecard. Weirdly, it kind of, the two things that really get people interested are, what are you doing? How contemporary is your offer? How advanced is your offer? What can you charge your people out in terms of how strategic are you? Are you production? Kind of, so much would dictate who might be interested in you. But then people immediately will look to, who are your clients? And that becomes one of the most important factors. Do you have clients that I want? Do you have clients that I could have in my organization? So are you able to service my clients with your capability? Because that's primarily why most deals are done, to add in a geography, add in a capability. Is the quality of your work the same as mine? And do you have clients that I desire? An easy way of looking at that is, if you've got 200 clients all on, £10,000 a year, right?
Yeah.
Then then they're pretty small clients. You're not really doing much for them, versus having, 2 clients on £100,000 a year. It's like, okay, well, you've probably got some pretty good relationships to be, kind of giving them 100 grand for them spending 100 grand with you. So, you can kind of see the dynamic and the level of engagement you're getting with clients, and you kind of couple those two elements together. But then you sort of dig slightly beneath that. It's really starting to look at the management team, because, so if you take a service business, it is the management team. That is what you're buying. So how is that structured? How is it incentivized? Where is the strength in depth in that organization? Normally you'll have 1 or 2 entrepreneurs that are exceptional, hence why they've built the business they have. But, if the proverbial bus comes along, where is the, what is it that you're buying? And Deloitte once explained it to me as, is it a proper business? And in services, it's probably about 50 people, to say that it's not going to fall over, and that it's kind of got a scaled opportunity. You've got to build that management layer to grow as well, right? You don't want to sell at the peak of your game. You want to be able to at least have, kind of 2 or 3 years left of growth. But then you can kind of get into the financials and kind of how you work, and the growth of the business and the profit of the business, and so much of that will dictate the buyers that will come to you and the price that they'll pay. So kind of they, for me, are the value drivers, whereas the other aspects are the deal drivers. But it's quite hard to just point to how much should you have as a retainer versus kind of what percentage should it be. It should always be the highest percentage you can get it. Because the more surety you have over your revenue, then the more you're going to drive interest and thus valuation.
Perfect. That's a really great answer. Joe, I'm going to move to a couple of questions we've received from the audience,
sure,
to kind of keep that up. And the first one we have comes back to what I suppose is the valuation, is how do you value an agency? And I'm sure we've touched on some of that, but
sure.
If there was just a really concise answer to that, what would you say?
Well, okay, so it's, if you're looking at It depends if you're going to be valuing the business on revenue or whether you're going to be valuing business on profit. Okay. And if you're going to be valuing it on revenue, it would be dictated by the buyer. Okay.
Yep.
Why would you look at revenue? 2 reasons. The growth is, there's not a lot of profit. The growth is very high. So therefore you're looking at, multiples of revenue as the metric, or you're looking to integrate that business and therefore the profit's important, but actually that's what you're looking at and what you care about. If you're looking at profit, then, it's far more, and revenue, often there'll be more surety, which is kind of around revenue streams, which is, akin to the growth opportunity. Where you're looking at profit is where, is the truer measure of businesses. And I'd say 90%, if not 95% of deals are done on profit. Okay. The revenue ones are very rare if you look across the entire M&A landscape. Because people ultimately are looking at, how much, what's my payback? How long and what do I need to believe before I'm going to make money out of this transaction? Now it depends upon the buyer and the sector and how desperate they are, for example, and the competitive advantage. But normally there's always a maths that sits underneath it, and that will be linked to the EBITDA. So kind of EBITDA is much more a focus of your profitable businesses, whereas revenue is the other way around. But you've got to have the growth coupled to be in the revenue space.
Okay, cool. Great answer. And the second one is, should you look to acquire an agency with similar or complementary skills? And I think you alluded to this earlier, but for the audience.
So should you look to acquire a business that's got complementary skills?
Yeah, with similar or complementary skills.
Yeah. Okay, cool. So I think there's 3 reasons you do M&A, right? You do it for capability, geography, or scale. Okay. Geography and capability invariably are going to be more strategic and more valuable. Scale is, going to be less value because all you're really doing is adding more to kind of what you already got. And for me, it's not a reason not to do it, but it's a reason, you're always going to have less value in that kind of situation. So, if you're going to embark on M&A, scale can be strategic, right? It depends on the size of your business. If you're adding 2 businesses together and go, I've got critical mass, and that can be strategic, just to caveat that. But if you're looking at M&A, right, you've got to think that you've got to have, I think, 100 grand in the bank to do the M&A, right? Because opportunity cost, and I'm talking relatively small businesses, that scales quite quickly for, a decent sized business. It costs you £250,000 to buy it. And that, I'm talking like £1 million of profit or, £10 million deal value, something like that. So anything smaller, even anything, in terms of your opportunity cost, the fact that you're drawing yourself away from new business and client work, because it's normally the CEO that's doing this. You've got to make sure you've got the strategic value is enough that it warrants embarking on that journey, because, it's expensive. But if you believe that, and, and that's the journey you want to go down, then I can see, as I said before, in a disaggregated marketplace, I think there's a huge opportunity to bring businesses together. And almost to go back a bit to that valuation question, if you can scale your business, there is definitely an increase in valuation for larger, rarer businesses.
Perfect. Great answer. Joe, I think that really wraps up today's conversation, which I think has been action-packed and very in-depth for what's been a good 25-minute session there. But the last question is, are you working with anyone looking to buy businesses? And if you are, and listeners are wanting to sell, how do they get in touch with you?
Cool. So, I'm one of 10 partners and directors globally in my organization that are constantly talking to buyers. The buyers that we talk to are across consultancy, technology, marketing, businesses primarily, which I think would be interested in a lot of your listeners' businesses. So there are always people that we know of that are looking for capability, and I think what you guys do as a general community is in demand. If people want to get in touch with me, then I'm joe.hine at sipartnersglobal.com, or go to SI Partners website, and there's an info box there, and you can just click on that and someone will pick it up pretty quick.
Brilliant. And is there any golden nuggets you want to leave us with before we wrap this up?
Just keep growing. Keep growing. I tell you the one thing I would say, right? If you are thinking about selling, create a five-year plan today.
Okay.
Do the first 2 years of that 5-year plan, and that's the point at which you should sell. You need to have another 2 or 3 years of where the business is headed to actually make sure that, you know, and steam in your tank as an individual before you embark on a sale process. If you've run out of gas, it's too late. You need another 2 or 3 years of direction, of growth. You just want somebody else to help you out with it.
Perfect. Brilliant. Joe Hine from SI Partners, I appreciate you attending today. It's been like great having you on. It's been a really easy conversation. Guys, if you want to contact Joe, please contact him at joe.hine@SI Partners, or attend the website and fill in the info box. Thank you for listening. Joe, thank you for being here.
Thanks very much, Paul. Great to speak to you.